Give us your take on the quarter and what you heard from Bob Iger, and then also the tentative deal when it came to the actors. Did that change your rating, your price target?
Well, I'll do the actors one first. That I think was expected by the market that we would get resolution. I think people are happy to see it get done, but it doesn't really have any sort of doesn't change our view on Disney at all. For the quarter, I think you guys encapsulated it right. I mean, the revenues came in a bit light, but profits were much better. That's what the street cares about. And I thought the most important thing that happened on the call was the upsizing of the cost saves, where they moved that up to $7.5 billion from $5.5. And a lot of that came from lower content spending by about $1.5 billion lower content spending and about $500 million of lower operating expenses. And so what that means is that Disney is now going to generate next year free cash flow that exceeds levels that we saw prior to COVID.
Yeah, we're hearing so many people say how important it is to have strong free cash flow in this higher for longer environment. I want to come out, look at something else, ads. Were you concerned about what you heard when it came to ads? You've heard a lot of companies talk about weakness in ad spending, some citing the Israel-Hamas war. Is that a long-term concern for Disney?
Not a long-term concern. I mean, I would agree that the ad market has been it's been a very strange ad market, to be honest with you. National's been weaker than local. We've seen real weakness in some pockets and strength in others. You know, that one of the tactical things, I mean, the strike getting done will sort of at least cause the media and entertainment companies to start spending more. So that's good. But I think we'd all like to see a better ad market, but I don't think many people have much confidence that the ad market's going to inflect materially higher over the next few quarters.
All right. One of the strong points in this report, the theme parks, they continue to grow. However, at the same time, we're talking so often about a stretched consumer and so many people spending with their credit cards and those rates even hitting some historically high levels. The theme park business, is that growth sustainable?
I think it is sustainable because if you think about the parks business, you have to put Disney's parks sort of in one pile and sort of regional parks and a lot of other businesses in another pile. The Disney parks now are so expensive. They're sort of they're sort of targeting very high-end customers. And so somewhat paradoxically, these higher interest rates in a weird way sort of help affluent households generate more income. It's the lower end households that use credit cards, that have dwindled their savings. And that's not really Disney's core customer. So the numbers were quite good at parks, and I suspect they will endure.
All right, so the streaming services, again, the bright spot for this report. I want to get your sense. How should investors view Bob Iger's comments that they're looking for a strategic partner when it comes to ESPN and some of those other streaming assets?
Yeah, Mr. Iger's been pretty expansive. He said maybe we'll partner with distribution companies or tech companies or sports leagues. I've sort of viewed that as a red herring. I think the only logical partner for Disney is to partner with sports leagues. Why? It's to insulate Disney from getting into a bidding war with some of these big tech giants that are beginning to move into sports rights. And so the most logical way to do that is to give leagues themselves a stake in ESPN. So then they have to weigh, do I take the higher cash payment from a big tech company and diminish the equity value of my ESPN stake or not? And so I think it's a very smart move on the part of Mr. Iger, but we'll see if the leagues do it.